This is one of the videos that come your way unplanned. It's Christmas. Today is on 25th December 2024, and I take this opportunity to wish you a Merry Christmas. I received a message from one Joyce, which I wish to read or quote. I am Joyce, and I consulted you around March. That should be March of this year 2024. Last month, I received a dividend message of 35,000 from my Sacco. Thanks a lot for the advice to start with a Sacco. Now I'm thinking I think she meant now I'm thinking of debt arbitrage after watching your video in YouTube. Yes, I do have a video on debt arbitrage in my YouTube channel video portfolio, which you can check. I will also put the link to that video in the description. Then she goes ahead and asks a question. What is dividend advance? The Sacco say I can access it at 75% of my dividends. Three takeaways from that message, and the first one is dividend. And I want us to look shortly about dividend because the way the term dividend is used in the Sacco sector varies slightly from the way we use it from investments in equities or stocks, commonly shares. Then the second takeaway is about the debt arbitrage, which she has mentioned. And the third one will be about the dividend advance, how it happens, how it's created, and how you access it. And probably we shed more light about the dividend advance and whether you should go for it or you should be patient a little bit more. Then maybe we can touch a few things here and there about SACCOS. And that will be coming your way after 3 seconds short break, so don't go away. You can give us a like to the video, give us a comment as always, and share it to another person. See you after 3 seconds short break. Welcome back, and it will be beneficial if we begin by looking at what is required of you at the point of registering to become a member in a Sacco. There are three things that are very important. The first amount that you pay is a registration fee that ranges from 300, 200 to about 1,500 shillings. The most common is 1,000 today for most of the good Saccos. Once you have paid the registration, you are required to start putting in your monthly savings. Those ones are commonly known as deposits. Most Saccos would require you to accumulate a minimum of about 2,000 to 3,000 worth of deposits or savings in a month. So you are not required necessarily to put a lump sum or a single amount of the total in a single day. You can build up on with different deposits to accumulate the required minimum in a month. Then the third item or the third payment that you're required to be putting in is your share capital. If you have SACCOS will give you a minimum amount of shares that each member is required to hold. And that amount is supposed to be accumulated over time. So in most cases, you will be putting a small amount over time until you achieve the minimum required amount, which in most cases, you will be required to have built that amount before you start accessing some loan benefits, but it will not be tied to all of the loans. It also means that such amount can be recovered from your loans once you access them. There is another amount that you may be required to pay, and that one also goes on a monthly basis, and this is the benevolent fund, and we'll be looking at its purpose later. The importance of looking at those figures is to identify, because the most important thing that we wanted to look at is the dividend aspect and what it means. So we have to look at what as a member you are supposed to be putting into your accounts. So we have the two accounts that are key here. We have the deposit account, which you commonly referred by many as savings. Those monthly amounts that you put as your savings, the ones that you accumulate to take loans against, those are deposits. Then you have the share capital. So those are the two accounts that pay you an income at the end of the year. There are several other investment accounts or other forms of accounts that would also be generating some incomes if you are holding such accounts. But the most common accounts that must be held by all members in a SACCO, there are those three. You have a deposit account or the savings account, you have a share capital account, and you have a benevolent account. Those three accounts form the part of a SACCO that we call the BOSA, back office saving activity. Then we have the front office, the FOSA, the front office saving activities for those SACCOs that operate banking-like activities. So back to our two accounts, the deposits and the share capital accounts. That is where we derive the dividends that are paid to the members at the end of the year. So dividends, by definition, is a proportion of a company's profits that is set aside and shared to the company owners or providers of share capital proportionate to their shareholding. That said, we come back to the SACCO. SACCO assumes three forms in one. SACCOs are companies, and that's why they have the LTD initial at the end of their name. A good example is when you talk of ABC Savings and Credit Cooperative Society Limited. The LTD part, that is what signifies that SACCOs are companies. And just like any other company, SACCOs are owned by the members to extent of their individual shareholding. For that reason, the second aspect of the SACCO is that SACCOs are cooperatives by virtue of the fact that they are registered and incorporated under the Cooperative Societies Act. And that law requires that for the extent of shareholding and ownership by every member, SACCOs are to be owned equally by all members, unlike companies where shareholding can vary from one member or one shareholder to another. SACCOs limit the amount of share capital that can be held by one member so as to uniformly distribute ownership to all the members. And for that reason, as per the law, you cannot own more than 5% of the paid up share capital of a SACCO as an individual. So what we are calling dividend in a SACCO will consist of two payouts of incomes. There is the other bit of deposits. So deposits also attract an income we call an interest. So the interest from the SACCO subsector, we call it an interest rebate. And rebate, by definition, if you look at the meaning of that term rebate is an amount that you get refunded in situations where you are believed or felt to have paid in excess or more than you should have paid. That comes in the aspect that the monies that these SACCOs lend out to the members, they are also sourced from the members. These are members' funds that are on lent to the other members. So you would imagine, like ordinary chamas, that members should be accessing the money for free. But for SACCOs, you access those funds as loans and you pay interest on them. Once the year ends, their revenues or those interests that are collected from the member loans, after deducting the SACCO expenses of administrations and the like, whatever remains as the surplus is distributed to members as a return, a refund on the interest that you had paid earlier on. And that is the reason why it's called an interest rebate. But essentially, it is not distributed only to those members who had loans. It is paid out to all the members or account or deposit account holders to the extent of their amounts or their deposit balances. So the proportion that you are paid on account of the amount of deposits that you had invested with the SACCO, that one we call it an interest rebate. Then the proportion of income that you have been paid as a percentage of performance on your share capital. That is what now squarely becomes a dividend. But in the SACCO sector, the term dividend encompasses or closes the two. The amount that you are paid as an income on return on your deposits and the one that you have been paid as a return on your share capital. The two form what in SACCOs we call dividends. So that is the difference that comes in when you compare dividends in SACCOs and dividends from investing in shares of other companies in the stock exchange. So the figure that Madam Joyce has given us as total dividends for the year amounting to 35,000 composes of those two things. There is a portion that constitutes the dividend on share capital, and there is a proportion now that comes from deposits. Once that has been done, now we look at what the dividend advance is. And from that statement, the way it is phrased as a dividend advance, you are essentially accessing a part of your that year's dividend in advance or before it is accrues back to you. For that reason, it is based on the previous year's performance because as per the law, before the dividends are paid out to the members, those dividends will be declared by the board of directors and proposed to the members for their approval or ratification during an AGM. These dividends are declared, the advances are declared or they are proposed as a product, they come before the year end. Today is on 25th, the year closes on 31st December. The AGMs are supposed to happen in the first 120 days of the following year. So we expect the SACCO AGMs to happen anytime before the end of April. So the dividends advances that are being proposed, they are paid out based on what is expected to be paid out next year. But the basis or their determination is based on previous years audited, proposed, and approved dividends by members in the AGMs. So for this one as an advance, the money is yet to be declared as yours. But this is a loan product. The advance is a loan product, which in most cases it is charged or offered at an interest rate of between 9 to 12%, varying from one SACCO to another. It is a loan product that whose repayment ability by the member is based on your expected dividend income. So most individuals or members would feel or take an offense that they are being charged an interest on their own money. I've already stated or given the reason why it's not yet your money, because it has not been approved by the AGM. But there is it is clear out of the proposal, a dividend must be approved by the AGM. So on that expected income, SACCOs relieve their members of their need for money. Instead of going for a Shylock, instead of going for expensive loans outside, or instead of jeopardizing the dignity borrowing around, the SACCO offers to give you access to your future incomes in advance, where the security for that amount or loan that you are accessing is the expected dividend amount, and for that reason it becomes a loan. The other question would be whether it's worthwhile going for the dividend advance or waiting for the full amount once the dividends are approved by the AGMs and paid out. And we cannot have a fixed answer. It depends on your circumstances. For a member who is in need of money, instead of going for more expensive sources like borrowing from the expensive mobile applications, you can access these advance at an affordable rate of 9-10%. While on the other side, these other mobile apps will be charging you exorbitantly. Once you access this amount, the full loan, the amount and the 10% interest will be deducted from the dividend once it is approved by the AGM. Then you'll be paid the balance because as our statement read, you can only or she can only access a 75% of that amount. The 30% or 25% that will braid around is to take care of taxes, because these incomes that you are getting from a SACCO, they are also taxable with a final tax. The withhold tax is final and is charged at the rate of 15% for the income or the interest that is paid from the deposits, and 5% of the dividend or the income that you get paid from your share capital. There is also the element of interest that will be recovered from that amount. Then the balance, the net balance, will be credited or paid to the member once the ratifications are done. Then we have the third item, that is debt arbitrage. Debt arbitraging is a process where you identify and access affordable finances or capital when you are able or you have available investment vehicles that will be able to pay you a higher return. Where in this case, you profit from the difference in the interest rate from the investment vehicle and the finance cost or the interest rate charged on the source of that capital. A good example, because SACCOs offer affordable loans compared to the other lenders in the finance sector. The other source where you can get such affordable loans could be staff loans from employers. Once, for example, you are able to access a SACCO loan at the rate of 12% per annum, and you identify an investment vehicle where you can invest and get a higher return. And a good example is the OC Fund. OC Fund has paid at a total or annualized rate of 29.32% for the last or for a period of about 9 months. If you look at the 29% from OC Fund and the 13% or 12% from the SACCO, this will leave this Madam Joyce with a net return of about 15 to 16%. Then if you were to consider the other maybe smaller costs that relate to investments, the transfer fees, the loan processing fees, and a few, these Madam Joyce will not miss out in the range of 13 to 14% net return. That is what we call debt arbitraging. You're able to access capital cheaply and invest it at a higher return, benefiting from the difference in the two rates. The same can also happen in markets where you buy a product from a cheaper market and you retail the same product in another market, giving you a difference in price. That is your return. That is debt arbitraging. Being in a SACCO is beneficial because it gives you a way of managing your emergencies. Look at the emergency loans or access for funds that SACCOs offer. You are able to access very quickly processed loan facilities. An example, in most SACCOs will process an emergency loan in less than 12 hours. Accessing your finance or your funds from majority of the money market funds can take you days, 1, 2, or 3 days, depending on the channel that you're using. This is not to pitch a difference or to pitch a competition between a SACCO and a money market fund from the fund manager, because the two are created to suit different needs. But for a SACCO, they have facilities that you can access, and the question of security is not necessary. It depends on the circumstances that you are in. If you are seeking an amount that is within the amounts that you have already invested or put into your deposit account, then that is self-secured loan. Then you have SACCOs will support you in times of development. You are able to access multiple amounts of your savings. If you have saved like 200,000, you're able to access 600,000 to $1 million depending on the multiple or frequency of the loan that you are trying to access. While in all these other investment vehicles, you can only access to the maximum of the amount that you have invested and maybe any return that is due to you. The other thing is that SACCOs give you a way of building a social security. SACCOs offer social security and welfare in that contribution. There's something that we mentioned about a benevolent fund. Benevolent funds, those cumulative or it's a collective investment schemes by all members of a SACCO, which give them forms of security, social security, and welfare. They not only cover or secure the loans, insure the loans that you access, but they also come handy in the event of demise of a member, where such facilities they do give certain specified amounts of benevolence towards bereaved members. That question, Madam Joyce, is well appreciated. It has given us an opportunity to look at those few things about SACCOs. Thank you for watching.